Pankaj Murarka is CEO and CIO at Renaissance Investment Managers. Pankaj, good morning. Great to have you with us here. Thanks very much for joining us. Let's just start with this PSU theme, which is once again kind of sort of recycling and making a comeback, right? It was the leader of this bull market, and then it took a break, about a year and a half long break. And even within PSUs, lots of different areas which did well successively. But then, all of them largely re-rated, and then we've had a bit of a lull. But they seem to be coming back once again. OMCs, for example, is a case in point. PSU banks, etc. What do you own here, and what's your thinking about this space now, Pankaj?
Morning, Prashant. Yeah, you're right. Especially with OMCs and banks, we've seen coming back. I think the challenge with PSUs is fundamentally there's a lot of value. These stocks, despite the sharp run that we had in these companies between 22, 23 and the first half of 24, the starting point in 2022 was most of these state-owned companies were trading at like low single-digit multiples, or some of these companies were available in terms of valuation at 2 times EBITDA and stuff like that, where 2 years of cash flows just pays for the company. So the starting point itself of the rally was so low that we had a very ferocious rally. But I think the challenge with PSUs is from here on, while these companies continue to do well, the markets needs to see more reforms from governments. And I think which is where probably the anticipation is, because in case of oil companies, at least we've seen government make some clearly nuanced announcements where they said that these companies will not be forced to cross-subsidize across LPGs, and they are now getting paid for the LPG losses that they had in last year, which helps their cash flows going forward. And oil price being benign, the underlying fundamental numbers continues to remain good. And likewise with state-owned banks, where there once again, we've seen a very strong interest in Indian banks. We've seen over $10 billion of foreign money coming into financial sector in the last 8 weeks. And I think there's some expectations about some reforms in coming budget. Probably it could be another round of consolidation within state-owned banks, and I think which is what is driving interest back into these names. So from a valuation perspective, they're always cheap. I think the trigger point for PSU's rally is always the government actions in terms of reforms, because that is what can really drive a re-rating for these companies.
Okay. Pankaj, hi, great to have you on the show. So tell us on a slightly broader level whether you are looking at the portfolio in any fresh light, any major churn or changes in the last month or two as we've gone through this consolidation with the market now practically coming back to the earlier highs.
I'll tell you what has worked for us and probably what has not worked, but what I think will going forward work for us in 2026, or how we are positioning ourselves. So clearly 2 things that has worked for us this year or in the last year has been private sector banks. They've done well, and I think they'll continue to do well. And the other is our exposure to internet companies. Again, by and large, they have done well. What has not really worked for us is our exposure to IT to that extent. And probably we were somewhat early into the consumer sector. So we've seen some moves in terms of stock price and consumer names, but I still think it's early stages. I think both of these sectors are poised for a meaningful, healthy returns for shareholders in calendar year 26. One, in case of consumption, I think the resurgence in consumption we're seeing post the festival season is actually surprised on the upside. Someone like a Maruti, they've had like 100% Y&Y growth in their festival bookings, and they're running low on inventories on a lot of car models. You have wait periods which are like 6 weeks or 8 weeks, and something like this we are seeing after 4 years. Something like this happened in 2021 post-COVID unlocks, and now after 4 years you're seeing that wait periods on cars. So that's very pleasing to hear or witness kind of thing, and which effectively tells us that there's a lot of latent demand that exists, and consumers now have the money in their pocket. So probably this consumption recovery will sustain over a longer period of time. So I think 2026 will see a very meaningful recovery in consumption, and probably I think some point of time this will surprise us on the upside. And secondly, while IT as a sector has not done well, but what has happened is in the last 2 quarters, we have not seen incremental earnings downgrades on the sector. So clearly, earnings have troughed out. And the way macros are poised and the environment is poised, it looks like we are in for a recovery in IT spends, global IT spends going into the next year. So logically, meaning expectation is that the growth for IT companies next year will be much better than this year. And valuations are at trough, and the stocks are down about 17-18% this year, which makes, from a valuation perspective, even more attractive.
In fact, just keep an eye out. What's good about this earnings season is select companies report good numbers and the street likes it. Intellect Design Arena, just pull up the intraday chart of that stock. It's moved to the high point of the day. The revenues have jumped, I think, close to around 34%. EBITDA is up by 68%. And I think the company has been talking about, 20% growth in revenue in the future as well. They've been saying that they're confident on the trajectory. So just take a look at that stock, up 7.5% as we speak. Pankaj, a more general question to you with regard to the past quarter's earnings. It seems, I was looking at a Motilal Oswal note and various other brokerages as well. Till now, it appears Q2 actually hasn't been as bad as what the street had anticipated. They're optimistic that things improve from here on, but Q2 has been reasonably better. What's your view on with regard to your reading of earnings? And also, if you could tell us with regard to asset allocation, because the frequent asked question now is how much you put in gold, how much you put in equities, how much you put in bond. If you could give us a rough matrix according to you.
Absolutely, Nigel, you're absolutely bang on. The good thing about this earnings season has been that there's been no incremental downgrades. After 5 quarters almost, we're seeing that there are no incremental earnings downgrade. And more importantly, we are seeing some earnings upgrade. So, and I think those earnings upgrade will build on from here on, because probably after having downgrade consensus earnings for almost 5 quarters in a row, I clearly think the analysts are somewhat more circumspect and need to see more evidence of sustainability of growth before they go out and upgrade their growth estimates or earnings estimate going forward. So you're absolutely right. I think, meaning we are in the second successive year for India in terms of single-digit earnings growth for the nifty companies. But more importantly, all of us know the second half of the year, financial year, will be better than the first half. So clearly, we are near the trough in terms of earnings deceleration, and earnings have clearly troughed out. I think we'll start seeing earnings deceleration, earnings acceleration from the second half of this year. So I think the outlook for earnings after almost 5 quarters looks pretty good, and that makes me feel optimistic on the outlook for markets as well. In terms of asset allocation, Nigel, actually, I'm not the right guy, because I've been a 100% equities guy all my life. So for me, there's only one asset class that exists in the world, and that's equities. And there's nothing that excites me more than equities, So my asset allocation is very simple. A bull market or bear market, 100% equities.
All in.
All right, Pankaj, we'll leave it on that note. Thank you very much for joining us. Good to get that perspective on the markets. All in and a positive view coming in on stocks going forward.